Welcome to the deep dive. Bitcoin has really been on quite a ride lately, making some serious headlines. I mean, it just rocketed to a new all-time high, didn't it? $118,077 on July 13th.
Incredible numbers, and the whole crypto market cap went with it.
Yeah, $3.68 trillion globally. And Bitcoin's dominance, climbing past 65%, it really makes you wonder what's, truly behind all this momentum. So our mission today is really to unpack this whole thing. We want to pull back the curtain on this incredible surge. We'll look at the big institutional forces driving it, the regulatory side of things, which is always interesting. And crucially, we'll explore those signals that suggest, well, both huge opportunity, but also maybe some risks still lurking there. It's complicated, right? We want to help you connect the dots.
Exactly. And guiding us through this, our main source material comes from excerpts of a piece called Bitcoin's Ascent, Institutional Demand and Market Dynamics. So this deep dive, it's really about cutting through the noise. We're looking at the why behind Bitcoin's recent moves, highlighting some dynamics that might actually surprise you, things shaping its future.
Okay, so let's jump right in then. The primary catalyst seems to be, well, massive institutional demand, right? We're seeing these U.S. spot Bitcoin ETFs, the ones that actually hold Bitcoin, their inflows topped $1 billion over 2 days straight. That's just a staggering amount of money pouring in.
It really is staggering, and it's not just abstract numbers. We see actual companies making moves. Take Aker ASA, that Norwegian firm. They're holding, 754 Bitcoin now?
Okay.
But even more dramatic, maybe, is Metaplanet in Japan. They've seriously upped their game, boosting reserves to 15,555 Bitcoin.
Wow, 15,000.
Yeah, and they've apparently seen over 95% returns on those holdings already.
Incredible.
And this isn't just, a few companies dipping their toes in. This kind of institutional buying, it starts to redefine Bitcoin, doesn't it? It moves it away from just being this speculative thing towards, maybe a necessary part of a company's treasury or portfolio.
Like legitimate asset class territory.
Exactly. It's that kind of validation, that institutional nod that could really open the floodgates for a whole new type of investor.
That makes sense. So, okay, you've got all this big money coming in. Bitcoin's image is kind of shifting.
Yeah.
What's happening on the regulatory front?
Yeah.
Are governments, keeping pace? Or are they playing catch up? And how's that affecting these big players?
That's a really important question because regulation is, it's always a huge piece of the puzzle in crypto. And we have seen some significant moves lately. The U.S. Senate, for instance, passed the Genius Act.
Right, I saw that. That's for stablecoins.
Precisely. It's aimed at providing clear federal oversight for stablecoins, the ones pegged to dollars and such. And at the same time, the SEC is apparently busy drafting its own framework for crypto ETFs.
Okay, so multiple things happening there.
Yeah, and these moves, they're designed to bring some clarity, some structure, and that in turn affects how legitimate and stable the market feels, especially for these big institutional players. It could make them feel more confident, maybe lead to even wider adoption down the line.
It's interesting, though, the SEC drafting its own rules alongside the Genius Act. But, often when you get more regulation, especially in a new market like crypto, doesn't it sometimes risk slowing things down, stifling innovation? How do these specific rules, like focusing on stable coins and ETFs, balance that need for legitimacy that institutions want with keeping the crypto space dynamic for them?
That is the absolute core tension, isn't it? You hit the nail on the head. On one side, clear rules give institutions the certainty they crave before deploying huge amounts of capital. They like defined boundaries. But on the other side, if the rules are too heavy-handed, too prescriptive, they absolutely could slow down that rapid innovation that's defined crypto so far. These specific actions, though, focusing on stablecoins and ETFs, they seem to be targeting the main on-ramps for traditional finance. So the goal seems to be stability first, which, frankly, big institutions tend to value more than just pure unfettered innovation.
Makes sense. So beyond just buying and holding Bitcoin, it sounds like some major players are actually getting involved in the infrastructure side of things too, making some aggressive moves there.
Oh, absolutely. There was a really ambitious announcement from Tether's CEO recently.
Tether, the stablecoin issuer.
The very same. They've stated they plan to become the world's largest Bitcoin miner by the end of this year.
Wow, largest miner. That's huge.
It is. And they're expanding operations across Latin America to make it happen. So this isn't just about stacking sats, as they say. It's about investing heavily in the mining process itself, the thing that secures the network, creates new coins.
So it's a deeper bet on the ecosystem itself.
Exactly. It shows a belief in Bitcoin's long-term utility, going beyond just the price, building out the foundations.
But does that raise any concerns like about mining power getting too concentrated with one big player like Tether jumping in so aggressively?
That's a fair point, and it's something the community always watches, mining concentration. Any significant consolidation definitely needs monitoring, but for now, I think it speaks more to their deep, long-term commitment to the space rather than an immediate centralization threat. Time will tell, of course.
Okay. So we've covered a lot of the bullish momentum, the institutional drive, the infrastructure plays, but like you said, it's complex. We need to pivot now and look at the other side of the coin. What are the areas of caution, the risks that people, need to keep in mind?
You're absolutely right. It's crucial to have that balanced view. And one really critical point is that despite all this institutional hype we've been talking about, retail investor interest still seems surprisingly low.
Low retail interest, huh?
Yeah, it's a really key counterpoint. It signals maybe some caution or perhaps just a different type of engagement from individual investors compared to previous bull runs.
That is a crucial counterpoint.
Wow.
But I wonder, does low retail interest automatically mean caution? Or could it be that maybe retail investors are getting their Bitcoin exposure differently now, like through those ETFs we mentioned? So they're participating, just not buying directly on exchanges in the same way.
That's a very sharp point. And honestly, it's probably a mix of both. Some retail investors definitely might be using ETFs now, and that activity wouldn't show up in the same on-chain data we used to track. Good
Mm.
point. However, the data also suggests that the kind of direct speculative fever from individuals that we saw in past cycles, it just isn't quite there to the same degree yet.
Okay, so maybe a more measured approach, or maybe just a lag.
Could be. It's definitely a distinction worth watching. And then, layered on top of that, you still have the persistent security risks. Those haven't gone away. We saw a stark reminder recently with that huge phishing scam, right? $245 million stolen led to a 19-year-old's arrest.
Yeah, that was shocking.
It's just a clear sign that even as the market matures, vulnerabilities are still very real. Users absolutely need to stay vigilant.
Definitely. And it's not just scams, right? Are there technical market indicators flashing any warning signs? Anything pointing to potential, maybe volatility ahead?
Yes, actually. If you look at the on-chain data, analysts have noted a noticeable spike recently in Bitcoin's coin days destroyed metric, the CDD.
CDD. Okay, remind us what that means again.
Sure. So CDD basically measures the economic rate of transactions by looking at how long the coins involved have been sitting dormant, unmoved. So when you see a big spike in CDD, it means a large number of old coins, coins that haven't moved in a long time, are suddenly being transacted.
Ah, okay, so long-term holders might be moving their Bitcoin.
Exactly. And historically, analysts often interpret that as long-term holders potentially taking profits off the table, which, can raise concerns about a possible sell-off coming.
Right, increased supply hitting the market.
Precisely. It gives you a glimpse into what those long-term believers might be thinking and signals potential short-term choppiness.
Okay, so we have this real tension here. On one hand, huge institutional excitement, big players building infrastructure for the long haul. But on the other, you've got maybe cautious retail, ongoing security headaches, and technical signals like CDD flashing yellow. Yet, despite all that, the overall bullish feeling about Bitcoin seems to hang in there, doesn't it?
It really does. Even with the counter arguments, the bold predictions haven't stopped. You still hear forecasts from, certain analysts and market participants eyeing Bitcoin hitting maybe $168,000. Some even say $200,000 by the end of the year.
Wow. Still aiming high.
Yeah, and those predictions, they usually lean heavily on that continued institutional wave, maybe wider global economic shifts favoring Bitcoin. It just underlines again that this market is, well, it's a really complex beast,
Yeah.
full of massive opportunity, but also very real volatility.
So wrapping up what we've explored today, it really comes down to this fascinating core tension, doesn't it? You have this incredibly powerful force of institutional money pushing Bitcoin to these dizzying new heights. But then that's contrasted with maybe a more hesitant stance from individual investors, plus those persistent, very real security concerns that aren't going away.
Absolutely. And understanding that complex interplay, the massive investments coming in, the regulators trying to shape things, alongside the undeniable risk that remain, that's just essential for getting a handle on where the crypto market stands right now. It's definitely not a simple, straightforward story. It's more like a mosaic, requires looking at it from multiple angles.
So maybe a final thought for you, our listener, to chew on. What does it really mean for Bitcoin's future when its price is being driven so strongly by these huge institutional players, while direct interest from individuals seems, well, quieter for now? How might that specific dynamic shape Bitcoin's path forward, especially given that inherent mix of, yes, incredible opportunity, but also undeniable volatility, something worth mulling over?